So the biggest mistake people make is they don't look at their investments and their allocations and their assets in a 3D mindset. And so most advisors, they're not connecting each world, right? Especially within the real estate world. And so this is why it's really, really important to have someone who understands real estate at a deep level, investing at a deep level, and also debt and structuring at a deep level, but more so bringing the team together to talk. I mean, think of it like the most successful family offices are doing this.
When someone's really good at something, they make it look easy. It looks easy because they're excellent at it. They're skilled and they have experience. And you just assume that because someone is good at something, their kids can also do it. And a lot of times they can't. A lot of times their giftedness is totally in other areas.
All right, here again, Brett Swarts, Dan Palmer. We're going to talk about some DST questions and some general thoughts. Dan, how are we doing this morning?
Doing great. How are you?
Phenomenal. All right, kick it off, Dan. What do you got?
So, yeah, just as we've been going through calls, I'm just writing down questions of things as a non-real estate, non-tax professional, non-deferred sales trust professional, learning as I go, just writing down questions. I hear you talk, Brett, with all of your expertise. And so just figured I got a list of questions here we can just kind of walk through, and you could share your thoughts on some of these questions that maybe other people watching these videos would have the same questions I have.
Perfect. Rock and roll.
Okay, so, in the joint venture partner with a trust, they get a new stepped up basis. Can you explain how that works, what the stepped up basis is, why it's a powerful tool for people who are in real estate?
Yeah, so this is part of the series of how to make the DST an investment and not an expense through what's called tax flow new depreciation schedules. Is whether what we're trying to accomplish. Depreciation helps to offset cash flow. We call it tax flow. For every dollar that you have in cash flow, ideally you have a loss of depreciation to offset. So technically, you do not get a stepped up basis when you go into the trust, but what you can do is joint venture partner with the trust to get a stepped up basis in a new asset. And so an example would be, let's say, an apartment complex that was worth $10 million in Sacramento, California, and it had a zero basis. You've owned it for over 30 years. You'd fully depreciate it. You had zero debt. To keep it simple, you sold to the trust in exchange for a promissory note, and you deferred $4 million of tax. You would have paid 40%. So instead of having $6 million, you get a $10 million promissory note. Let's make it at 9% to keep it simple. That's $900,000. Okay, so once the funds are there, you can just be completely passive, and you could simply have the trust pay you back over time. We invest into, lending, and you can put into stocks, you can put into real estate and business ventures. But our most of our entrepreneurial clients and real estate clients, they actually like to be active. Many of them do, and so this gives you the ability to get a new depreciation schedule. So watch this. So instead of the 10 million just going into stocks, bonds, mutual funds, and passive investments, you can go into a new real estate property. So let's just take 7 million as an example. You take 7 million, you put that a down payment on a $14 million apartment complex, and the 7 million is coming from the trust. Okay, so the trust puts it into an LLC, and let's make Joe the person who's the LLC owner, and Joe is the managing member. Joe has 80% ownership of that, and the trust puts up all of the money, the 7 million. And it wants a preferred return. We typically mirror the note at 9%. But the very act of this is like two partners coming together, buying a brand new, or a new asset. I mean, it doesn't have to be brand new property. It could just be a regular, property, right? But a $14 million property in a new LLC, which means it has a fresh basis, right? So this is what we would say is you're getting a new basis, right? It's not stepped up. It's literally brand new right now. And so, but important to understand that the only time that people benefit from stepped up basis is when they are looking at stepped up basis only upon death, right? So, and only if they hold on to the real estate or the business or the stock. So that might be years in the future, 10, 20, 50, 30, 40, 50 years, depending on how old you are, right? So would you rather have a basis that's new today or wait till you die, right? And so little caveat, way we typically structure is 80% to keep it commercially reasonable, meaning that although it's a $14 million new schedule, about 80% of that can go to Joe in this scenario. So I'll pause there, Dan. What's unclear, or what do you want to point out?
So the only downside of not, of staying with the deferred sales trust is upon your death, you would normally get a stepped up basis. Your kids would get a stepped up basis. But in the trust, you don't. They can step into your shoes though and continue receiving the payments indefinitely. But once they sell, they're going to pay that capital gains tax. Is that
You got it.
accurate?
Yeah,
Okay.
you nailed it. Yeah, for DST 1.0, that's spot on, right? The kids step into your shoes, and there's no stepped up basis on a promissory note, traditional 453 installment sale reporting, or a seller carryback a note. That doesn't have a step up in it because it just doesn't qualify. Okay, but the kids can step into your shoes and maintain the tax deferral, which leads into, typically we ask clients, hey, what matters the most to you? Like, what are your dreams? What are your aspirations? What are your goals? And most of the time, especially as they're, 55, 60, 65, 70, they're getting older, they want what's called truly passive income. Okay. And the second part is that their kids don't necessarily want to step into their shoes and own real estate or know how to manage real estate. They don't really have a passion for that. They have a different passion, different calling, or the business. And so the let's say the owner now, he also knows when it's probably a good time to sell the asset. He probably can negotiate it better. And there's all those reasons why you want to sell it today versus waiting for this stepped up basis. Okay.
Mhm.
And so when they sell, we can unlock what's called truly passive income. We typically can double or triple their cash on cash return without doing any of the work, which is remarkable for people. It changes their lives. It changes their family tree, changes their ability to give and make an impact today. And so that's what we focus on, like a laser, and then say, and how cool would it be if your kids can step right into your shoes and continue your legacy of that giving and that kind of truly passive income. And when people hear and understand that and see that, it changes everything. It's literally transformational for families that they no longer have to trade, blood, sweat, and tears and tons of time and energy for the income that they're receiving. They can literally sell and defer, harvest the gains, but not have to pay the tax in the year of sale, and then they slowly live off income and just pay taxes. You do that, and so that's really the
I think
entire
also
model.
when someone's really good at something, they make it look easy.
Mhm.
It looks easy because they're excellent at it. They're skilled and they have experience, and you just assume that because someone is good at something, their kids can also do it. And a lot of times they can't. A lot of times their giftedness is totally in other areas altogether. So having that truly passive income may be a way better outcome for the kids rather than them trying to wade into an arena where they're kind of set up to fail because they don't have the same giftedness as their parents who built kind of the wealth for the
Yeah,
family.
and they might have the giftedness, but here's the key: like, who are they called to serve? Right? They may not be called to serve that same customer, that same tenant base, that same location, that whatever it might be, it would be real estate or a business or like who do they want to become and who are they called to serve? That's really the two who's make the why, right? The why behind the thing. And if they don't have the why, guess what? They're probably not going to be that into it or be as good of a steward as they could be or really, stay for the long haul. So that's important. And then when you have multiple kids, that can also create some complexities, right? Now I want to also shift to the DST 2.0 because it's important to understand that we have a 2.0 version that it passes estate tax free and capital gains tax free, which essentially eliminates the need for the stepped up basis, right? But does so much more than the stepped up basis because it eliminates the death tax or the estate tax, whereas the stepped up basis does not eliminate that. That's where it hits a ceiling. And this is when we kind of leapfrog over the top of that. And that's known as the DST 2.0. The downside of the 2.0, just so everyone knows, is that when and if you use the 2.0, and these are typically reserved for 20, 30 plus $1 million exits, or at least you're worth 20 or 30 million plus, as a married couple. So you have a large estate that we need to solve some estate tax challenges for. The primary thing is like, hey, I want to solve this death tax. I want to be a great steward with the wealth, and I don't want to have my kids to be forced to sell something or buy a bunch of life insurance that's really expensive, or have to give it all away to charity, or or have to try to gift it away to kids, which I run out of time. So in one swoop and one sale, we can eliminate all of the estate tax, defer the capital gains tax to a point. They will receive payments during their lifetime, and this acts kind of like a private annuity, where as they receive payments during their lifetime, they will pay partial cap gains tax, partial ordinary income, and they'll get a return of their basis if there's any basis remaining. And so that's important to understand. It's a fixed number, and it just flows out every year. However, let's imagine you did a $100 million exit. You set the DST 2.0 up, you live for another 10 years, and we outproduce, and let's say potentially we double the money in 10 years, right? So now it's 200 million, and you may have lived off a certain percentage of that cash flow from that trust. But all of what's remaining in the trust after you and your spouse die, proper planning, your kids can be the beneficiaries, passes estate tax and capital gains tax free. Like this is the kind of the big.
This is the 2.0.
This is the 2.0, right? And so, yeah, we eliminate that rejection of, well, I don't get the stepped up basis, so I might as well hold it. By the way, we never want to talk you into anything, right? We're the first to tell you, like, hey, if your property's going great, your assets, your bills are great, especially if you have any kind of health concerns, like you might just, I've turned people away and say, don't use the DST. Hold on for the stepped up basis. I've had kids call me and like, hey, my mom and dad's kind of in a tough spot. Mom passed away a few years ago. Dad's, maybe towards the end. And I said, don't use the DST. Hold on for that stepped up basis. It's less expensive. It's in a sense less complicated. You don't have an estate tax problem. That's why we're Capital Gains Tax Solutions, plural S. It's not just one size fits all. Sometimes it's multiple strategies combined to solve the Rubik's Cube problem, and the analogy of trying to get the colors to line up, as best as we can. But oftentimes, once people ask themselves the question, what matters to me most, typically cash flow, truly passive income, legacy, simplicity with their family and passing that wealth, as well as getting out of debt, getting out of the toilets, trash, termites, time and energy. The DST is just like transformational for families. And so we also don't want to talk people out of it. If we think it's a good fit, we're the first to say, this is a great fit, you should go for it.
So back to the depreciation schedule. I've heard you in some of the talks talk about depreciation recapture. So depreciation being, the loss that can offset the income that you're receiving from the payments. How does depreciation recapture work? How does that impact the deferred sales trust? How do we solve that problem?
Yes, it all depends on what kind of depreciation that we're talking about. There's 1245 and 1250 are the main two, okay?
Okay.
And one's basically accelerated or through bonus depreciation where you're squeezing the time frame to a shorter amount and you're taking more benefit up front. And if having enough years have gone by to basically season that depreciation and you sell beforehand, typically that is not deferrable within the deferred sales trust, especially the 1.0, okay? Now, the 2.0, depending on the nature of it, depending on the time, there are opportunities there to do that. Like there's something called like equipment depreciation. We're using Section 179. It gets a little bit complicated. We need to get your CPA. We got to go to the tax attorney. We got to do kind of an X-ray of how you've taken the depreciation, when you've taken it. Okay, but the 2.0 typically can cover more things. Okay, so like equipment and like a big private plane that has that you've done bonus depreciation on, and like it's some cool stuff. Important to understand that we can never defer capital gains taxes or depreciation recapture when you have debt over your adjusted basis. Okay, that is like the black hole, right? So like if you have that, there's nothing that's going to take that away or be able to defer that. It's going to you're going to pay that tax on that, right? So be aware of that. You always want to have your tax flow, your cash flow, and your debt flow mindset, understanding of where everything's at, especially before you exit. And so the way that you solve that is you pay down your debt to your adjusted basis prior to closing. It cannot be paid at closing. Okay. That's one way. Or like in the last video, we talked about solving what's called mortgage over basis or debt over basis through a Delaware statutory trust. If you have a qualifying transaction, which is an investment piece of real estate and you are an accredited investor. Okay, so there's multiple boxes you need to check here. This is part of why we only work with deals that are $1 million net proceeds and $1 million gain. Really what we're saying, Dan, is they need to be an accredited investor because so many of our solutions are only suitable and actually legal to use for accredited investors, right? So Yeah, does that answer the question on the depreciation piece?
Yep. Yeah, definitely. Thank you for that. That
But by the
helps.
way, straight line, let me also clarify straight line depreciation, no problem, right? We
Yeah.
can defer all of the straight line depreciation, no problem. Again, as long as the debt's not over the adjusted basis, right? And we can defer 100% of that. That's phenomenal. So the only time you
Okay.
kind of get,
Accelerated depreciation is the problem.
yeah, that's where it can become a problem. But the 2.0 typically, depending on the fact pattern, can solve that. We have to look at that on a case by case basis for the 2.0, but 1.0, yeah, it's going to be characterized at a different front. And let's say you did accelerate depreciation, but you waited 10 years. Well, guess what? You're given that time frame to catch up with that. And so it can actually, I don't know how exactly this happens, but it can kind of get back into the normal range, right? Where people get in trouble is they do this big bonus depreciation cost seg deal, and last year they just did it, and then they're selling next year, right?
Yeah.
In that scenario, what do you do? Well, we'll probably just try to do a 1031 exchange if it qualifies as an investment real estate property, because you're in that tough spot. If it's business, again, that's going to be tough. Or we look at the 2.0 to see if we can solve that.
Okay, so just to get clarity, walk. I just heard you say this, and it's actually on my list here. So walk through the cash flow, debt flow, tax flow, uh, philosophy that you have.
Yeah. So the biggest mistake people make is they don't look at their investments and their allocations and their assets in a 3D mindset. It's almost like watching, TV in black and white. And then all of a sudden it comes in color, and then all of a sudden it's 3D, right? And so most advisors and most even CPAs or even financial advisors or real estate people, they're not connecting each world, right? Especially within the real estate world. And so this is why it's really, really important to have someone who understands real estate at a deep level, investing at a deep level, and also debt and structuring at a deep level. But more so bringing the team together to talk. And you think about like the most successful family offices are doing this. And so what they're looking at is they're looking at risk, and they're like, rule number one, don't lose money. Warren Buffett. Rule number two, follow rule number one. And so one of the best ways you don't lose money is you don't have debt. However, you don't have a chance to leverage and grow as much if you don't have debt. And so we talked about smart debt and dumb debt, right? Dumb debt is when you're going into deals where like the market's really hot and you're paying a high price, and like you're like, but I'm still just going to double down and go in more debt. And you're like, oh wow, that's tough. Dumb debt means you're not typically fixing for longer periods of time than you know that the next market cycle could happen. This is happening right now. People who bought deals a couple years ago, unfortunately, overpaid and took on adjustable debt. The only reason they took on that adjustable debt is because they felt like they were forced to. Like whenever you feel like you're forced to do something, you have to do something because either the market's not participating or buyers are pushing prices up. It should be like red lights. Okay, I am taking on excess risk here, and I might get burned. And that's what
Mhm.
happened. I went back and looked at the multifamily deals, and we made a couple mistakes. Like on some smaller investments, we definitely diversify, but on a couple of them, like we got into some deals that were overpriced and it was pretty hot. Now, for the most part, we didn't do that. Actually, in fact, I think 97, 98%, we went into debt deals, which was great because the
Mhm.
same thing that's blinking red lights as an equity owner, it could be an opportunity to be a debt owner. And that's what we did. Meaning, we lent to those who were going into real estate. So we actually did more of a flip where we got away from buying, although we got caught on a couple because, we thought the value add, we thought the rents, we thought the things. Now those deals, most of them have turned out fine. I mean, we did some capital calls, and they're doing okay. At least one, we're probably going to lose all of the investment. Now, fortunately for that client, he's worth about 10 million, and it's about $100,000 that it'll lose, unfortunately, right? And we're learning our lesson. Now, he was a very smart guy. He's owned apartments, and this is actually a deal in Texas, and it just didn't work out. And so, sometimes you learn. But the point of that is, looking back at these signs, you don't want to go into debt when you feel like the market's really hot. In fact, it's just the opposite. When the market shifts and the prices start to drop, that's the time to go into debt. We call that smart debt because you're being strategic. Now, the flip side of that is obviously interest rates have went from, let's say, 3.5 to 6.5, 7.5. That's part of why the deals are so low, right? So now you're having to take on more debt here. So do you take on that debt and pay for that property? Well, maybe not, depending on the deal, right? This leads into the cash flow part of it, right? Cash flow is going to be, your net operating income, and then minus any debt service that you have. So you got to be aware of that. What is my cash on cash return? What is my overall time frame for that investment? Is it a 3-year commitment, 5, 10-year commitment, or is it a 2-year commitment? Or can I get the money out in about 30 to 60 days? Some of the debt deals that we have are out about 30 to 60 days, making double-digit returns. Another one we have, Dan, is it's paying 16%. It's a quarterly plus 30-day payout. It's about a 2-year commitment. And so you start looking at these different pieces. And the last piece, which to me is just as important, or the most important, is tax flow, because the government has a $36 million spending. I don't want to say it's more than a problem. It's a, I mean, they need to go to spending anonymous, right? And also maybe a lot of them need to go to jail for what they've done recently. We've learned, right? It's a disaster. But the problem is then we have to pay the taxes. The American taxpayer does, right? So
Mhm.
you've always got to be aware that your most expensive thing in life is what you don't know. The second most expensive thing in our lives is taxes. Okay, so we've got to have a strategy that can either offset the cash flow, can delay the income tax, right? This is important to be able to compound. Time is the single most important aspect or foundation to investing. So if you put time in the middle of all three of these: cash flow, debt flow, tax flow, and time is in the middle. And if we can try to control time, meaning control when we take income, which means we can control when we take tax, control when we can go into debt, which means or equity, go into deals. That means we don't have any forced 1031 challenges. Then all of a sudden it's like we're in 3D, right? We can see in
Mhm.
3D, we can see the risks, we can see the challenges. We're not rushed to make decisions, and we can make more suitable investments for ourselves, for our clients. So that's basically the tax flow, debt flow, cash flow mindset.
Yeah, this is my favorite part of the conversation because, in a complex situation like somebody's wealth building and their assets and the exits from things that they've been working on for years, to see the strategy come together to create a whole picture to say, this is what is going to meet your needs, solve your problems, and drive the wealth of your family forward. And so I love that conversation, Brett, just hearing the strategy that goes into to all three of those different areas and how they can sync together to get our clients exactly what they want.
So what's next,
Yep.
Dan?
All right, next. What's the different impact when using the deferred sales trust if somebody is utilizing an S corp, a C corp, or an LLC? How did the different vehicles impact the deferred sales trust?
Let me start with what's the most ideal situation when people show up to us, right? They show up with a LLC. It's a single entity LLC that's only selling that single asset. Okay. And or it's a joint venture LLC, and there could be multiple partners, no problem. And again, it's just an LLC. It doesn't file an S corp return, and it's just simply an LLC. It files a partnership return. It issues K-1s to the partners. That is like the most beautiful, flexible way to exit into the DST. Number one, okay. Now, if you have an S corp or a C corp, you can absolutely still work with those. In fact, the DST becomes even more valuable for especially the C corp, because C corps can get hammered on tax on the way out. I've seen, I gosh, I mean, 40, 50, 60. I seen one like 67%. It was in California. That was going to be the tax liability. Part of it's because you're getting extra advantages up front with the C corp, okay? But with the DST, depending, as long as there's no debt over basis, we've structured deals to be able to defer all of that. We did one in Colorado recently for one of our clients, Nick, and that was a big C corp exit, and he was blown away. His CPA was blown away what we could do for him and how we helped him defer. And I think he would have been around 45% of the proceeds, would have been crushed in tax. So that's big. So we can work with all three of them. Okay, now talk about the S corp. So the S corp typically there's partners, or can be. We might just have to do a dissolution of the business or the entity within the year of the sale. It's an election that you can have, and we don't want to get into like the proprietary stuff here, but there's ways to do that, and so it's no problem. The only complexities that come in sometimes if there are partners, and sometimes there's like a partner who's worth 80, he has 80%, another partner has 10, another partner has maybe or 15, another partner has like 5, so it's 80, 15, and 5, and that 5% may not be big enough to do the DST. We would have to typically on an S corp ask them to cooperate, or a C corp to cooperate with the person who's doing it at 80, maybe the person doing it at 15, meaning you would close and then the trust would issue a promissory note to the first two who wanted to do it. And the third one, they might just pay them. So it might take an extra couple days. They need to cooperate to do it outside of the traditional escrow. So maybe delay a week of getting or 48 hours from getting payment. That's the only real complexities on the S corp that I could think of right now. But yeah, our strategy works for any asset of any kind and really any entity of any kind, as long as it's subject to U.S. capital gains tax. So regardless if you live in the U.S. or not, if you're selling something in the U.S. that has $1 million net proceeds, $1 million gain, we can use the DST to help you out.
Okay. Do we have time for two more
Yeah,
questions?
sure.
Okay. Question number one. In a lot of our conversations with people, when you're determining if they're a good candidate to utilize the deferred sales trust, you talk about the percentage of tax paying on their exit. How do you calculate that, and what are you looking for to determine if the deferred sales trust is like a home run for them or a double for them? How do you do that?
Yeah, we would call it, I guess we would pin this the capital gains tax ratio to proceeds, right? Numbers never lie, right? I mean, it's part of what we're seeing with Elon Musk and the tech bros, right? They're just going in and they're just reporting the numbers, right? And they're
Yeah.
just doing an analysis, and we approach it very similar. We don't want to have to convince anyone to do this or not do this. We want the numbers to speak for themselves. I think, Dan, we talked about it like when we show that ROI side by side comparison, and we just walk them
Yeah.
through, what would it look like in 10 or 15 years if you do the trust versus not, and people's eyes get open, and the numbers just do all of the talking. And so what I like to see, a good healthy ratio, is about 20% or more of the proceeds are at least going to be deferred. Now, let me clarify what I'm saying here, right? Capital gains tax rates are, minimum typically about 2024, but as high as 37, 40, 45, you can be 50 depending on depreciation recapture. That is the percentage of the tax rate on the gains, okay? So I'm going to give two scenarios to really bring this to life. You might have $1 million tax liability, but you're selling $100 million deal. So in that scenario, Dan, is the
Mhm.
DST a good fit? The answer is no. Why? Because it's only 1%, a 1 million on 100 million is the tax deferred, right? We charge on the 100 million, right? And we charge on the AUM. And so that's not a good ratio at all. Like that's, just pay the million of tax and take your 99 and go, right? Go, right?
Yeah.
Now, let's do the flip side of that. Let's make it the extreme. Let's imagine that 50% of it was going to be taxed. That's 50 million on 100 million. Well, that's a no-brainer, right? Like, wow,
Yep.
50% more to work for me. Great. So then we start to narrow in on, okay, what is a good ratio? And we found about 20%. 20%. So 20 million deferred on 100 million feels good. That's kind of our floor. Every dollar or percentage above that gets better and better and better. And it's important to understand that debt has a piece of this too, right? You might be selling $100 million deal. Let's make it smaller now. Let's do a $10 million deal. Okay, Dan. And let's say it's $1 million of tax. However, you have 5 million of debt. So now what is 1 million by 10 million? Well, that's 10%. Well, but what if I paid 5 million? I only have 5 million. Well, now 1 million of 5 million is 20%. Boom. I'm in the nice ratio here. So we always want to be aware of our equity, because our equity into the trust will determine the fees, right? And our actual tax liability that we'd have to pay. Now that's ROI just one. We can go into more, but I'm going to pause there to make sure you're kind of getting that,
Yep.
how the ratio is determined and why it's important.
Yeah, yeah, that's super important. I think you call it tax pain. Like, is
Yes.
there enough pain to, to justify, utilizing the deferred sales trust? So,
Yep. Yep. And by the way, the
so
tax pain is not just the million here in this
yeah,
scenario. The tax pain is also the ordinary income tax year in and year out.
yeah,
So if we set the promissory note on a $10 million note at $900,000, 9%, but you're like, I only need 300,000 to live on average per year. I mean, I might need to adjust that over the time, and we can absolutely do that on a 1.0 very easy. Well, that's $600,000 of deferral every year. And so you can also calculate the tax pain. Let's just say 600 is at 40%, whatever that number is. That's, maybe that's 200,000, you know, 220,000 or something like that.
240,000.
240, right? That's also tax paying year in and year out. And this is the best kept secret of the DST. It's not just the initial, I get to defer $1 million. It's I get to defer 240 year in and year out, year in and year out for when? To win. For as long as you want. You can just live
Yeah.
off partial interest payments
Yeah,
and
that's a
let that
really powerful piece that a lot of
boom.
people don't pick up initially.
Yeah.
They're so focused on deferring the capital gains tax,
Mhm.
they miss out on the fact that they can also defer that the interest income.
Yes. It's like 1D versus 2D, right? Or
Yeah.
peeling back the onion. It's like back to the, tax flow, cash flow, and debt flow analysis. Like you really have to understand the essence and the nature of each layer here. And that's how you make the DST an investment and not an expense. And it becomes not just a traditional deferral tool, it becomes a wealth building machine. Like it becomes you go on offense, not just on defense, right? All of a sudden you're on offense. And that extra 240 per year, by the way, let's imagine you took that 240 per year extra and you just gave it to charity, right? What kind of impact could you have every single year? You're like, you're not, when there's certain amounts you can give per year before the exemptions kind of run out. But I'm imagining 240 is probably pretty reasonable when you're making 900,000 a year. And that 240 every year could just making an impact, and it offsets the tax, right? And so you're like, hey, I'm happy to do that, right? I think most of us, and we're okay paying tax if we feel like the stewardship of the capital was going to things that actually benefits all of the people in an equitable way, right? We loathe waste, right? We
Yep.
loathe waste, and we loathe corruption, and we loathe non-transparency. Like, I mean, the this is what we're seeing. This is the Doge revolution, right? And so I think the DST even becomes more powerful, Dan, because now that we're seeing behind the curtain, right, just how bad it really is, and we're just getting started. Hundreds of billions of dollars being wasted in fraudulent, types of scenarios. It's like you can go there, or we can keep it in the hands of you and your family and the causes you believe in, that you have transparency on. I mean, and I want to come back on another video that I'm learning some stuff from Tony Robbins and his new book about finance and about investments, and looking at private equity versus the stock market and performance over the years. We'll make that video here next. And it's all coming together even clearer now. Why we've been doing private equity. We can hold people accountable. I mean, you look at someone like Nancy Pelosi. What is it? She makes 174,000 salary per year, on average, right? And she's worth $240 million.
Yeah. Doesn't
Like,
make sense.
the math doesn't lie, right? There's something going on. Follow the numbers, and be careful, not to be confused by that. So yeah, we're in the revolution together, and we're hoping that it stays with people and causes. And no matter who you vote for, like, you probably have causes and things that you believe in and you want to support. Go for it, right? Versus, defer it and put it into those causes versus just giving it to a government, no matter what side you're on, that's likely to waste it away, or for their buddies or their own pockets later on somewhere else.
Yep. Just a follow-up question on the tax paying. The 3.8% for Obamacare, when does that apply and when does it not apply?
Yeah, so you want to be aware of that for sure. So definitely it applies on passive, okay, like passive real estate. But I've heard different things on this, and so I think I need to get it clear on my side. We need to go to the tax attorneys and find that out. Um, but definitely passive investments that you're selling. Now, if I own a real estate property and I hire a property management, but it's my own property, does it still apply? Check that out. I've heard if you're like a professional practice, like we just helped the dentist out of Oregon, and because they're professional practice owners, they're dentists, it didn't apply to them. So that was kind of like news to me. So I'm still kind of learning, Dan, on that. So I
Well, you're
think,
like my Mr. Miyagi, so if it's not clear to you, there's no way
yeah,
it's clear to
we
me.
definitely need to get clear on it.
That's
I
on my
think there is a
list.
clear part of it. We need to get clear on that, because I keep hearing sometimes, and then I feel like it's I've had mixed analysis from different CPAs on when it applied and didn't apply. But we'll get clear on that. We'll come back and we'll report to everybody.
Okay, last question I have on my list here, and you can go as deep or as surface as you feel is best for the listeners. But what are the types of audits that have come to the Deferred Sales Trust? I know you've mentioned state, federal, promoter, formal. You've mentioned no trigger audits. So can you just kind of walk through the audit tree that the Deferred Sales Trust has stood up under?
Yeah, so first of all, let's talk about the legal track record, and then I'll get into the details there, okay? So the deferred sales trust is still batting 1,000, okay? What does that
Hmm.
mean? We've never had a change or a finding on any of the audits. We've never had a negative tax consequence for a client of ours. Well, no one's ever gone to jail. Like this is all completely a reportable. It's not a reportable transaction. It's not on the dirty dozen. It's never been on an IRS watch list. It has a completely clean background check. If you do a background check on me and Dan, you're gonna have a clean background check, right? Do a background check on the DST, it's gonna be clean background check. Just no issues, okay? Completely clean. Okay. So there have been audits, and it's important to understand that the audits have not been triggered by the DST. This is so important. Now we'll talk about the promoter audits here in a second, but at the individual audit level, right? What happens is the IRS will do audits typically on the larger deals, right? For example, there was a 125 plus $1 million Southern California real estate property sold. The DST was used, but guess what? It didn't trigger the audit. The $125 million sale triggered the audit, and they just went through it. And as they went through it, guess what? They found the DST. Guess what? They did an audit on the DST. Okay, all no change, no findings, no issues. That was actually on the 2.0 version, right? Because it's above that really that 10 million, 20 million mark. So no issues, no findings, all closed out, no problem, right? So that's happened over a dozen times. At this point, probably like 15 to 17 times at like the individual, or even probably 20 times individual level, where they're just bigger transactions, bigger business sales. I know there's one in New Jersey, of course, multiple ones in California. I think there's one in New Mexico. There's these different big transactions. The audit happens, no change, no findings. Okay, all good. Above and beyond that, they've done what's called promoter audits, right? And and that's like looking at the entirety of it all, right? Where they've gone to the law firm who created this and our business partners and said, hey, we want to call you guys in and just talk, okay? And we're like, no problem. Let me send you the audits. In fact, that happened in '08 was one of them. '08, full thing, and I think they met at the Long Beach State Building there, and the IRS came in, and they had this big meeting all day, and they go through it all, and in fact, that one I think was actually that state meeting was in I think around 2015 or 2016, but the one in 2008, 28 was they sent all of the files from that, and the people from like the 2016 2017 one, they hadn't seen those files. Like, so they did hey, we want a big promoter audit, we want to see you guys, we're gonna nail you to the wall, we know you're doing something, da 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 da. And they're like, hey, well, here's the file from the '08 guys, and so before we meet, would you guys review what we've been all doing the work? We're probably gonna answer all your questions. And so Todd shows up to the state building, right? And he's in the meeting, he's in the room, and they're like, hey, we want to let you know before we get started, like, everything is fine. Like, we reviewed all the stuff you sent to us. We have a couple other questions. We're going to send it back to DC just to do some other double checks. But so far, like, we don't see any issues with what you guys are doing. You guys are really smart, and you guys, basically are following the rules. And a couple things on advertising. Make sure you're saying deferral and not avoid, and a couple things like that. But that was it. And they had, that was back there, and that was no change, no findings, right? So this has happened.
Beautiful.
Those like big formal ones, right? I think FINRA has also reviewed this, and they're never going to come out and be like rubber stamp, right? IRS is not going to say rubber stamp, right? Or FINRA's not going to say rubber stamp, right? But they know, they are aware. I mean, there's been thousands of transactions, no issues, no findings. We're batting 1,000. Yeah, so far, so good. But more than that, like, this is not something we're testing. This has been
Yeah.
proven,
What
and
an incredible comfort for people that see the benefit of the deferred sales trust, but just are kind of ruled by fear because it can be scary to know that behind you is a firm that have been doing this for 28 years, thousands of transactions, billions of dollars in sales, and they're going to do lifetime audit defense, and they're batting 1,000. That is comforting for me just to think about. It's comforting to me as I talk to people and encourage them to go this route because of the benefits I know it'll provide to them and their family. For me to know that behind my word is this track record of perfect outcomes with audits. And so for me, that's comforting. I know it is for our clients as well.
yeah, certainty of conviction is really, really important. And remember, there's a audit window. It's typically 3 to 4 years, and we fully report everything. We walk your CPA on how to report it, and then the audit window expires. And for that transaction, there's, it's like the statute of limitations, unless there was some kind of fraud, which is no fraud, and you're using a professional, which you are. And even the worst case, even if they did audit you and they did find something, I think it's around a 10% penalty. And by the time that they find it, it's typically in year two, you've already had earned interest on it. So it's here. We want to help you out. If you have questions, of course, bring your CPAs on, bring your attorneys on. We invite them, and they typically join us after they spend about an hour or two with us or sign the NDAs and go through everything. We have third-party law firms. We have private letter rulings. We've got it all. You just, spend time with us, and, you need to set this up before close of escrow. Important to understand, ideally even before you go into contract. And then the last thing would be, you want to take action, go to capitalgainstaxsolutions.com. Schedule time with myself, Dan, or one of our team members. We're happy to walk you through, no cost, no obligation. We promise to never talk you into anything. We only want if it fits for you, and if it doesn't fit, we'll be the first to tell you. And if you don't think it fits, you tell us. It's okay. We just always ask it. You just spend some time with us, get to know us. You get to understand what the deferred sales trust is, and see if it's a good fit. Danny, last words for everyone listening out there.
No, I just want to say thank you, Brett, for just the deep dive into a lot of these questions. I'm sure it's as helpful for the listeners as it is for me. It's just so great to be able to help people in this way. So thank you guys for listening, and thank you, Brett, for your expertise and your knowledge.
Sounds good. Talk to everybody. Bye.